Stop everything you're doing. The Social Security Administration has officially triggered a massive rule change that is sending shockwaves through the retirement community. If you are a senior currently receiving benefits or planning to claim soon, the old way of calculating your monthly income just went out the window. We aren't just talking about a standard COLA increase you've already seen. This update marks the implementation of the new earnings test thresholds and a critical shift in how the SSA handles electronic payment transitions and overpayment recovery. If you are still working part-time or haven't updated your digital banking profile, you could be looking at a withholding trap that could freeze your checks for months. In this urgent update, we are breaking down the earnings threshold. Why earning even $1 over the new limit could slash your benefits by 50%. The security mandate. New protocols that could delay your next deposit if your account isn't verified. The tax credit shift. How to claim the new senior-specific breaks before the filing deadline. The rules of retirement have been rewritten, and ignorance is the most expensive mistake you can make. If you want to stay protected and ensure your hard-earned checks keep arriving on time, hit that like button right now to help us spread this warning to every senior in America. Now that we've established why today is such a critical turning point for anyone drawing Social Security, I want to pull back the curtain on the actual mechanics of these changes because the devil in the details is what usually trips people up. For years, we've operated under a set of rules that felt somewhat predictable, but the Social Security Administration has shifted into a new gear for 2026. This isn't just a minor tweak, it's a fundamental overhaul of how the agency tracks your income, how they recover debts, and how they deliver your hard-earned money. If you are one of the millions of seniors who has decided to stay in the workforce, perhaps to combat the rising cost of living or just to stay active, the updated retirement earnings test is something you need to memorize starting right now. The new annual limit for those of you who are younger than full retirement age for the entirety of 2026 has officially climbed to $24,280. On the surface, that looks like a win because it's an increase from last year, giving you more room to earn before the government starts looking at your check. However, the penalty remains just as sharp. For every $2 you earn above that $24,280 threshold, the SSA will withhold $1 of your benefits. The reason this matters today is that the SSA's tracking systems have become significantly more automated. In the past, you might have been able to catch up at the end of the year, but with the new real-time data sharing between the IRS and the SSA, those benefit reductions are being triggered much faster. If you hit that limit in the early summer, don't be surprised if your August or September check simply doesn't show up. For those of you who are lucky enough to reach your full retirement age in 2026, the rules are much more generous, but also more complex. Your limit for the months leading up to your birthday is now a substantial $65,160. Once you cross that threshold, the withholding rate is $1 for every $3 earned. This is a huge, safe zone for many professionals and high-earning seniors, but the transition is what catches people off guard. The moment you hit your full retirement age, whether that's 66 and 10 months or 67, the earnings test disappears entirely. You can earn $1 million a year at that point, and your Social Security check won't budge. But navigating that bridge year requires precise reporting because if the SSA thinks you're going to over-earn and they withhold too much, getting that money back can take a frustratingly long time. This leads us directly into the biggest and perhaps most controversial change that has officially taken full effect today, the aggressive new clawback policy for overpayments. For the better part of the last year, the SSA had been operating under a more lenient 10% withholding cap for those who were overpaid. It was a compassionate move designed to help seniors who were struggling with inflation. But as of this morning, that policy has officially reverted to a much harsher standard. If the SSA determines you've been overpaid, even if it was their mistake from 5 or 10 years ago, they now have the authority to withhold up to 100% of your monthly benefit until the debt is settled. There is a small buffer for some, but for the vast majority of beneficiaries, this means one mistake on your income reporting could result in your entire income stream vanishing overnight. I cannot stress enough how important it is to check your My Social Security account today to ensure your estimated earnings for the year are accurate. If you told the SSA you were going to make $20,000 this year, but your new part-time job is actually going to pay you $30,000, you are setting yourself up for an overpayment disaster. The agency is no longer waiting for tax season to reconcile these numbers. They are using quarterly employer reports to flag discrepancies. If they see you're on track to blow past that $24,480 limit, they will start the withholding process immediately. It's a pay now or pay later system, but the pay later option now involves losing your entire check rather than just a small percentage. At the same time, we have to talk about the digital mandate that has reached its final implementation phase. For decades, the wood grain envelope with a paper check was the gold standard for many American seniors. But the Treasury has officially closed the door on the era of paper checks for the vast majority of recipients. If you haven't transitioned to direct deposit or a direct express debit card yet, you are entering a danger zone. The SSA has warned that physical mail delivery for benefits is now considered an exception-only service. Unless you have a certified physical or mental impairment that prevents you from using electronic banking, or you live in a banking desert without internet access, the government is essentially mandating that your money moves digitally. This transition isn't just about saving the government $150 million in postage and printing costs. It's about security. Check fraud has skyrocketed in the last few years, with sophisticated rings targeting senior housing and rural mailboxes. By moving everyone to encrypted electronic transfers, the risk of your check being stolen out of your mailbox drops to almost zero. However, this shift has created a new kind of anxiety for those who aren't tech-savvy. If you're seeing a delay in your payment this week and you're still expecting a paper check, there's a high probability that your funds are being held until you verify a digital payment method. This is why the SSA phone lines are jammed today. Thousands of people are realizing the checks in the mail excuse has finally been retired by the federal government. And while we're on the subject of digital changes, we have to discuss the mandatory multi-factor authentication, MFA, that is now required for every single person who logs into their SSA portal. You might find this annoying, having to wait for a text message or an email code just to check your balance, but it is your last line of defense. Scammers in 2026 are using AI spoofing to impersonate SSA agents and convince seniors to hand over their login credentials. Once they're in, they can change your direct deposit information in seconds. The new MFA requirement is designed to stop that, ensuring that even if a scammer gets your password, they can't touch your money without that secondary code that goes only to your phone. Now let's pivot to some good news, because it's not all about penalties and mandates. Today also marks the day you can fully take advantage of the One Big Beautiful Bill tax provisions when filing your 2025 returns. This piece of legislation has introduced what is being called the largest tax break for seniors in American history. For single filers age 65 and older, there is a new enhanced standard deduction of $6,000 on top of the existing senior deduction. If you're a married couple and both of you are over 65, that's a whopping $12,000 boost to your standard deduction. What does this mean in plain English? It means that for the vast majority of you, your Social Security benefits will be effectively tax-free at the federal level. Think about that for a second. Under the old rules, if your combined income hit a certain threshold, up to 85% of your Social Security could be taxed. But with these new 2026 deductions, the threshold has effectively been pushed so high that only the top 12% of earners will pay a single dime in federal tax on their benefits. This is a massive win for your monthly budget, especially since the 2.8% COLA raise was largely eaten up by the hike in Medicare Part B premiums. By saving that money on your taxes, you are essentially giving yourself a second shadow COLA that the government isn't advertising as loudly. But there is a catch to this tax break. You have to claim it correctly. If you're using a standard tax software or a local preparer, make sure they are aware of the OBBB, One Big Beautiful Bill, senior credits. It's not an automatic check in the mail from the SSA. It's a deduction on your 1040 SR. If you miss it, you're leaving thousands of dollars on the table. And given that the price of eggs, milk, and electricity has remained stubbornly high, those tax savings might be the only thing that keeps your budget in the black this year. I also want to touch on a rule change regarding the trial work period for those on SSDI. If you are receiving disability benefits but want to try re-entering the workforce, the 2026 threshold has increased to $1,210 per month. This is the amount you can earn while still being considered in your trial phase. It gives you a safety net to see if you're physically or mentally ready to work without the fear of losing your disability status immediately. This is a huge opportunity for those who have seen their health improve but were too terrified of the SSA cliff to try a job. Today's updated rules give you a bit more breathing room to test those waters. However, for those who are not in a trial work period, the Substantial Gainful Activity (SGA) limit has also been bumped up to $1,690 for non-blind individuals and $2,830 for those who are blind. If you are on disability and your monthly earnings cross that $1,690 mark today, the SSA will consider you not disabled for the purposes of benefits. This is where the real-time reporting I mentioned earlier becomes dangerous. If you take on a few extra shifts this month and your paycheck hits $1,700, the automated system might trigger an immediate suspension of your benefits. In the past, there was a lag time that allowed you to explain a one-time spike, but the 2026 systems are much less forgiving. You need to be incredibly disciplined about your hours if you're hovering near that SGA line. For our Supplemental Security Income (SSI) recipients, the changes hitting today are more focused on the resource limits and in-kind support. There has been a long-standing rule that if a friend or family member helps you with food or rent, the SSA could slash your payment by a third. But as part of the 2026 streamlining, the SSA has significantly expanded the definitions of what counts as support. They are finally recognizing that in a high-inflation environment, families helping each other survive shouldn't be penalized as if it were income. While the base resource limits of $2,000 for an individual and $3,000 for a couple are still stubbornly low, the way they calculate your living arrangements has become much more senior-friendly starting today. We also have to address the Medicare Part B premium, which has officially settled at $202.90 for the 2026 year. Because most of you have this deducted directly from your Social Security check, today is the day many of you are seeing the real version of your 2.8% COLA. If your benefit was $2,000, your COLA raise was $56. But since Medicare went up by nearly $18, your actual take-home increase is only about $38. It's a bitter pill to swallow, but knowing the exact number helps you plan. If your check looks smaller than you expected this week, it's almost certainly due to that Medicare deduction or a change in your state's tax withholding. There is also a new Fairness Act provision that has finally cleared its last hurdle today. If you were a public servant, a teacher, a police officer, or a postal worker who was previously penalized by the Windfall Elimination Provision, WEP, or the Government Pension Offset, GPO, there is a new relief multiplier being applied to your checks starting this month. It doesn't eliminate the penalty entirely. That would take a full act of Congress, but it does soften the blow. For many of you, this will result in an extra $75 to $120 per month that you weren't getting last year. The SSA has been notoriously slow at identifying everyone who qualifies for this, so if you don't see an adjustment in your February check, you need to file a request for reconsideration, specifically citing the 2026 fairness adjustments. As we look at the landscape of 2026, it's clear that the Social Security Administration is trying to modernize, but that modernization comes with a learning curve for you. They are pushing more services online, they are being more aggressive with debt collection, and they are tightening the rules on work and earnings. But they are also providing historic tax relief and widening the doors for disability recipients to try working again. It's a push-and-pull environment where the informed senior wins and the uninformed senior gets caught in a web of paperwork and withheld checks. I want you to think of your My Social Security account as your financial dashboard. Today is the day to log in, verify your address, check your direct deposit link, and, most importantly, review your 2026 earnings estimate. If that estimate is wrong, you are essentially giving the SSA permission to take your check away later this year. By being proactive and updating that number today, you can avoid the 100% withholding trap that is now the agency's default setting for overpayments. We are also seeing a new initiative from the SSA to reduce the wait times for disability appeals. If you've been stuck in the system for years, today's rule change includes a mandate for AI-assisted hearing reviews. This doesn't mean a robot is deciding your case, but it does mean the mountains of medical records are being processed faster, which should hopefully clear the massive backlog that has left so many seniors in limbo. If you have an open case, check your status today. You might find that a hearing date has finally been set after months or even years of silence. Ultimately, the goal of these changes is to ensure the long-term solvency of the trust funds while adapting to a digital world. But for you, the beneficiary, it means you have to be more engaged than ever. The days of set it and forget it, Social Security, are over. Whether it's the new $24,180 earnings limit, the end of paper checks, or the massive new tax deductions, every one of these rules is designed to change how you interact with your money. You've spent decades paying into this system, and it is your right to get every single dollar you are owed. Don't let a technicality or a missed deadline be the reason your retirement is interrupted. As the February 11th payment date approaches for the first block of beneficiaries, keep a close eye on your pending transactions. If the amount isn't exactly what you calculated, factoring in the COLA and the Medicare hike, don't wait until March to fix it. The SSA's new customer service transformation includes a promise of shorter hold times, but we all know how that goes. Your best bet is to use the online secure messaging system, which creates a paper trail of your inquiry. In 2026, a digital paper trail is worth its weight in gold when you're dealing with a federal agency. We are living through a historic shift in how the social safety net operates in America. Between the One Big Beautiful Bill tax breaks and the SSA's digital-first mandate, the retirement you planned for 10 years ago looks very different today. But different doesn't have to mean worse. If you leverage these new tax credits and stay on the right side of the earnings test, you can actually come out ahead. The key is to stay informed, stay vigilant, and never assume that the SSA has your best interests at heart when it comes to their automated systems. You are your own best advocate, and by understanding these rules that started today, you are already miles ahead of the crowd. Keep tracking your deposits, keep reporting your earnings accurately, and keep demanding the transparency you deserve from the agency that manages your future. If you're ready to take charge of your financial future and make 2026 your most secure year yet, there is one final thing you need to do right now. The rules we've discussed today, from the new $24,180 earnings limit to the massive $6,000 One Big Beautiful Bill tax deduction, are only beneficial if you stay informed and proactive. The Social Security Administration's move toward 100% overpayment withholding and a digital-only mandate means that waiting and seeing is no longer a viable strategy for seniors on a fixed income. You have worked hard for every penny of your benefits, and you deserve to keep them without the fear of sudden interruptions or unexpected tax bills. I am committed to being your eyes and ears in Washington, tracking every update from the Treasury and every shift in SSA policy so you don't have to spend hours on hold or digging through confusing government websites. We are entering a new era of retirement in America, one that rewards those who stay ahead of the curve. By understanding the interaction between your COLA increase and the $202.90 Medicare Part B premium, and by ensuring your direct deposit is locked in securely with multi-factor authentication, you are building a fortress around your financial independence. If you found this breakdown essential for your retirement planning, please give this video a like and share it with a fellow senior who needs to hear this warning today. Your support helps us keep this community informed and protected against the changes coming our way.